Welcome, welcome, darling, to the Deep Dive, where we take Wall Street's most complex financial topics, douse them in glitter, and put them on the main stage. I am your guide, serving facts, high energy, and perhaps a slightly questionable amount of foundation, and I'm ready to get into some serious structural analysis today.
And I'm here, the voice of reason and spreadsheets, ready to translate all the glorious campy chaos into comprehensible knowledge.
Thank God.
Today, we are strapping in for what I can only call the ethical drag race of financial data. We're not just, analyzing the market's performance.
Yes.
We're judging the integrity of the players.
Honey, we are serving looks, and we are absolutely reading the receipts of Wall Street, checking every single invoice and every balance sheet. It is time to clock the entire system.
Okay, let's do it.
Okay, let's unpack this. We have a gorgeous stack of sources today covering everything from, the promises of decentralized ledgers to the, frankly, shocking reality of how reliable historical data actually is.
Right.
Our mission, to look past the glitz and glitter and see where the moral foundation is cracking.
And our deep dive today is, I think, crucial for you, the learner, especially in an era of just unprecedented data flow. We are examining the fundamental systems designed for trust, the market mechanisms, the data infrastructures you rely on.
The things you think you can trust.
Exactly, the things you think are solid. And we're spotting the friction, the biases, and let's be honest, the outright unethical behavior that turns a high-risk gamble into, an outright systemic risk.
Exactly, because I have to know, is this entire market trustworthy? Or is it that flaky hookup who promises you the world on a Friday night? Assures you they're single and looking to commit, but then, ghosted before the bill for the drinks even came.
Oh, we've all been there.
We need to know who is telling the truth and who's just serving pure deception.
Well, by the end of this, you will have the tools, the sophisticated tools necessary to distinguish between a natural systemic flaw, which is, inherent in complex markets,
Right.
an intentional shade, which is an ethical choice, and we are structuring this whole knowledge acquisition to 4 focused acts today.
4 acts. I love it. We love a dramatic, multi-part narrative.
That's right. Our 4 acts are, first, the data's wig reveal, where we're going to focus on quality, volume, and all the hidden biases lurking in the footnotes.
The footnotes.
Second, the shady backroom, where we analyze market structure, friction, and the explosive consequences of an unfair advantage.
Okay.
Third, volatility and validation, examining the performance of assets like cryptocurrency and how central banks are responding. And finally,
The grand finale.
ethical failures, lying, shading, and defaulting. We're looking at where integrity just completely collapses and leads to disaster. So let's start with the foundation.
The data.
The data.
Act 1, the data's wig reveal. Okay, so when we talk about big data in finance, we always hear about the 4 Vs. And honestly, the first 3 are giving basic in 2024. I am so tired of hearing about them.
Well, they're necessary context, right? The first 3 Vs, volume, variety, and velocity.
Okay, break it down.
Volume is just the sheer scale. We are talking about terabytes of transactional data every single day.
So much data.
So much. Variety refers to the format. It's not just neat, structured spreadsheets anymore.
Yeah.
It's raw logs, it's natural language processing of corporate filings. It could even be unstructured video or social media text.
It's messy.
It's messy. And velocity is how quickly it's generated and must be processed. Think high-frequency trading, where decisions are made in microseconds.
Right. So having volume, variety, and velocity is like owning every piece of fabulous fabric in the world, knowing every quick change technique, and having the fastest sewing machine on the planet. But if the 4th V, veracity, is off, honey, that's a synthetic wig that hasn't been brushed since 1999, shedding everywhere.
It's giving high-speed tragedy built on absolute garbage.
And that's the perfect analogy. Veracity, the truthfulness, the accuracy, the trustworthiness of the data, that is the real challenge in modern financial modeling.
It's everything.
It is. Dealing with massive unstructured data requires new data science technologies because traditional economic models, the nowcasting and forecasting stuff, they just don't scale.
So the old methods, the ones that rely on neat little boxes and assumptions of normal distribution, they're too slow, too narrow.
Way too slow, and they can't handle the messiness of reality.
Yeah.
They struggle with the complexity, the high dimensionality of these new data formats.
So you need machine learning.
You need machine learning solutions, but
Yeah.
And this is a huge but. When we apply these methods to economics and finance, we have a critical requirement that sometimes clashes with pure performance. We need interpretability.
You need to know why.
You need to know why. These models are often black boxes, right? They give you a prediction, but they don't show the underlying logic.
Yeah.
And for policymaking, for regulatory oversight, even for your own investment decisions, we need to open those black boxes up. We need transparency, or else we're just blindly trusting an algorithm. I hate when a performance is so mysterious that you have no idea what the concept was. It needs to be clear. It needs to land.
Yes.
And that requirement for clarity, that leads us to VDS, right? Veridical data science. Tell us how that checks the receipts.
Okay, so veridical data science, or VDS, is a framework explicitly designed to address the integrity of big data analysis. It asks, is this data-driven result truly relevant, reproducible, and reliable? It goes beyond just statistical significance.
Okay.
VDS asks these critical, practical questions. Where did the data originate? Is the source certified and trustworthy? And this is key. Will the conclusion predictably reemerge in future data?
Okay, I'm listening. Predictability is the key to minimizing dating drama too, so I get that.
Right. And the foundational idea of VDS is stability.
Stability.
In this context, stability means that your data-driven results, your conclusion, your model output, should tend not to change across reasonable alternative perturbations to the entire analysis pipeline.
Wait, okay, hold up. Elaborate on what reasonable perturbations means, like in plain English.
It means minor necessary adjustments. So, for example, if you change how you handle missing values in your dataset, or if you apply a slightly different but equally valid data cleaning method,
Okay.
or even if you use a slightly different algorithmic choice within the same family of models. If these minor changes in how you collect or clean the data fundamentally change your high-stakes conclusion, say, whether a bond portfolio is rated safe or risky,
Then it's not stable.
then your result is not stable, and therefore it's not trustworthy.
Okay, that is essential. Yeah. Stability is what I look for in a partner.
Yeah.
If changing one small thing, like whether I text him back immediately or wait 5 minutes, causes him to completely flip out and change his entire demeanor, then he's unstable.
Totally unstable.
That model, or that man,
Yeah.
is lying to me. It's giving me side-eye, and I need to ditch him immediately.
You absolutely should. And speaking of data giving side-eye, we have to discuss the fundamental issue of quality problems that are troubling academic and commercial financial research. And these are frequently hidden in the footnotes.
Of course.
It's the financial equivalent of whispering the drama quietly in the back corner of the club.
The tea is often spilled quietly in the back room, not on the main feed, because nobody wants to admit their multi-million-dollar data subscription is flawed. But, I mean, if we're basing trillions of dollars of global investment on these sources,
Yeah.
we need to know exactly how leaky the boat is.
We need to, and we should acknowledge the specific detailed discrepancies found in commercial databases like CRSP, the Center for Research and Security Prices, and CompassStat. Decades ago, researchers already identified significant issues. Benin, back in 1980, compared monthly return data between 62 and 78 and found that the overall error rate in CRSP was about 1 in 10,000 observations.
Which sounds low, but
It sounds low, but CompassStat was significantly worse. It showed an error rate of about 1 in 1,000 for the same period.
1 in 1,000, no, that's too many. If 1 in 1,000 of my potential stock buys turned out to be based on an error, I'd be furious.
You would.
That's a huge margin for error when precision is your job.
And those discrepancies, they're not random. They're concentrated in areas that are inherently complex and messy.
That's drama.
The high drama transactions, things like how stock splits are recorded, mergers and acquisitions, or complex dividend announcements. Greenblatt and his team, back in '84, noted glaring discrepancies in how stock split announcements were recorded between CRSP and the Wall Street Journal Index.
That totally tracks. The messy, dramatic transactions are where the numbers get confused, where the data entry person probably took a long lunch and just guessed. It's also prevalent in subjective assignments, right?
Right.
Like determining which standard industrial classification or SIC code a complex company falls under. If the assignment is subjective, the bias is already baked in.
It's already there. And beyond simple input errors, we have to address the pervasive systemic biases that threaten to invalidate huge swaths of empirical research.
Okay, give us the real read. What kind of bias are we talking about here? This is the core of the ethical failure, isn't it?
Absolutely. The first major one is survivorship bias. That's where only successful firms remain in the database, leading researchers to overestimate historical returns because all the bankrupt, failed firms have been removed.
Right, so you're only looking at the winners.
Exactly. Then there is ex post selection bias, and maybe the most insidious, the look-ahead bias. That's where researchers inadvertently use data they wouldn't have had access to at the time the decision or prediction was being made.
Oh, look-ahead bias is the worst. That's like judging a partner's decision-making today based on information you read in a gossip column 6 months from now.
Yes.
You can't use future knowledge to evaluate past decisions.
Yeah.
It ruins the statistical integrity and makes your historical models look way smarter than they ever were in reality.
And what makes all this worse is the systemic lack of transparency from the database vendors themselves. They are frequently not transparent about their exact data collection methods, their cleaning processes, or their management practices. They often fail to issue clear warnings to researchers about known or potential data problems.
They won't post the full story, only the highlight reel. They're hiding the messy, unedited footage.
And this lack of public transparency is a major, major concern. Like, consider Thomson Reuters IBs, a crucial source for earnings forecasts.
Okay.
When researchers have diligently compared different versions of their detail files across time, they found substantial retroactive differences. The vendor often gives private explanations to their academic clients, things like retroactive adjustments for stock splits or correcting errors that happened years ago.
Secretly.
Or the fact that brokerage houses maintain control over the distribution of forecasts, meaning academic subscribers often get only a carefully managed subset of the data.
The idea that a commercial vendor is silently re-editing the historical financial record behind closed doors is deeply disturbing. If you're not showing your work, if you're fixing errors without a public audit trail, you are hiding the truth. It's shady.
It's so shady, and it destroys the basis for replicable science. So if the underlying data itself is giving a fake out, we need a reliable forensic filter. This brings us to a remarkable analytical tool that detects engineered data: Benford's Law.
Benford's Law. That sounds like the name of a very stern but ultimately fair federal judge who specializes in accounting fraud.
It's an empirically observable phenomenon based on the distribution of first and second digits in naturally occurring data sets, things like street addresses, river lengths, or critically accounting figures. It states, and this is counterintuitive, that the smaller digits are dramatically overrepresented.
Wait, why is one so much more common?
It's because in data sets that cover several orders of magnitude, numbers spend more time increasing from one, say, $100, until they hit the next power of 10, 200, 300 before they hit 2.
Oh, I see.
So the number 1 appears as the first digit roughly 30.1% of the time, while the number 9 appears as the first digit only about 4.58% of the time.
That is fascinating. The natural distribution of numbers leans small. Who knew?
Researchers use deviations from Benford's expected frequencies to test for manipulation. If people are fabricating data, whether it's conscious or not, they tend to distribute the digits too uniformly.
Right, they sprinkle in too many 5s and 6s.
They do. So when researchers applied Benford's Law to bank balance sheet and income statement data, specifically looking at figures like loan loss provision or LLP and interest income, NIC, they were looking for intentional manipulation before and after the 2008 crisis.
Okay, before you go on, for those of us who are still finding the bar, what are LLP and INTC? We don't want to rely on undefined jargon.
Excellent point. Loan loss provision, LLP, is the amount banks set aside to cover potential losses from unpaid loans. It's a key estimate of future risk.
Got it.
Interest income, INTNC, is the revenue earned from loans and securities. Both are critical figures that banks might manipulate to smooth their earnings or hide risk.
Okay, so they used Benford's Law to see if the banks were making up their risk estimates and income statements.
Precisely. Benford's Law is like the ultimate financial lie detector. If your financial statements aren't following this natural law, they are giving a fake out. They're being clocked. And the results showed that this kind of manipulation transmits significant noise to the banking sector, which in turn distorts shareholder expectations and, critically, misleads regulatory authorities. When the numbers are trying too hard to be cute, Benford's Law catches them every single time.
That concludes Act 1. The wig is officially snatched, and the data is showing some serious roots. We've established that the foundation of modern finance is leakier than a broken faucet. Now let's move to Act 2. The shady backroom market structure and friction. This is where we talk about the price you pay just to play the game and how the game is rigged to favor the biggest players.
Right. So we need to start with the concept of friction. In a theoretical, ideal textbook market, transactions would be instantaneous and costless. A frictionless environment.
I take the seat.
A total fantasy. In reality, markets have significant friction, which is the total implicit and explicit costs associated with the financial transaction. This is everything from brokerage fees to the subtle costs imposed by large trading volumes.
Friction is the cover charge, the expensive coat check, and the 3 separate bottle service fees you pay just to get into the party and order a drink. The market wants to know, what are you willing to pay to get what you want right now?
And we know this friction is substantial because if you measure market volatility using metrics like volatility ratios, which is the ratio of opening half-hour variance to daily variance for high-volume stocks, these ratios are considerably greater than 1.
Okay.
1 would be the benchmark for a perfect frictionless market. The fact that they are so high, especially during high-price discovery periods like the market opening, shows that real-world trading is inherently costly and turbulent.
So what are the specific components of this financial friction that add up so quickly?
Okay, the primary component most retail investors encounter is the bid-ask spread. It's simply the difference between the highest price a buyer is willing to pay the bid and the lowest price a seller is willing to accept the ask.
Got it. The explicit cost.
That's the explicit cost. Then there is the much larger implicit cost, the market impact cost. This is the cost incurred by big institutional traders when they place orders so large that the sheer volume moves the market price against them.
Oh.
A massive buy order pushes the price up before they finish accumulating their position. A massive sell order pushes it down, reducing their revenue.
Oh, so the bigger your presence, the more drama you create, and the higher the price of that drama. That sounds like every celebrity sighting I've ever experienced. They show up, the price of everything in the room goes up because of the chaos.
Exactly. They effectively ruin the efficiency of the trade for themselves. And finally, there's opportunity cost, which is the possibility of missing a favorable price movement while you're waiting for a better execution price. These 3 costs are fundamental to strategic decisions about where and how you place your orders.
And speaking of where to place orders, let's talk about the structure of the market itself. We have the transparent main stage exchanges, the lit markets, and then we have the dark pools. It sounds like we're talking about a very exclusive, underground, slightly illicit club.
We basically are. And this evolution of market structure was driven by technology and deregulation. I mean, before the early 2000s, the NYSE used to have an 80% market share for its listed stocks.
Wow.
Today, that share is hovering around 20%.
That's a severe drop in relevance.
Yeah.
The Queen of Wall Street has lost her crown.
She has. And that order flow is now dispersed over multiple public exchanges and roughly 40 dark pool trading facilities.
Yeah.
Public exchanges, NYSE and NASDAQ, are the lit markets because they have mandated pre-trade transparency. You can see the bids and offers.
Got it.
But intense competition and the fragmentation of order flow among all these venues can ironically harm the quality of price discovery overall.
I mean, how does more competition make the price worse?
It just introduces complexity and opacity about where the best price is right now. Now, contrast that with the dark pools. These are private trading forums operating outside the public eye, lacking pre-trade transparency. And they came about primarily to facilitate block trading by institutional investors.
Let's talk about that institutional whale. Why do they need the darkness?
Okay, if a large institutional investor, say a massive pension fund, wants to buy 5 million shares of a major company, sending that order to a public exchange would cause massive market impact.
Right.
Everyone would see the huge demand, and the price would spike immediately, driving up their average cost thanks to that market impact cost we just talked about.
They would ruin the party for themselves.
Completely. So dark pools allow these institutional investors to get their large orders filled quietly, anonymously, mitigating those impact costs. And what's interesting is dark pools are also used for internalizing small retail-sized orders from brokerage houses, which bypass public exchanges altogether and may offer a marginal price improvement over the public spread.
So while the public is gagging over the continuous order-driven market on the lit exchanges, the institutional queens and the small retail orders are back in the VIP section, getting their trades filled quietly.
And potentially at a slightly better price point.
It's an ultimate exclusive benefit for the chosen few. It's shady, but when you are carrying that much weight, you need that privacy to manage your own drama.
But the regulatory tension is constant because, dark pools arguably undermine the very notion of a public, efficient price discovery mechanism, which relies on transparency. And this tension sometimes explodes into full-blown public market catastrophes.
Which brings us to the GME saga.
Which brings us to GME.
GME was the ultimate reality TV moment for finance. It was the season 13 finale, the ultimate takedown featuring unexpected heroes.
The GameStop volatility from late 2020 through 2021 provides a historic case study of market friction, coordinated behavioral economics, and the vulnerability of heavily shorted positions.
Okay, lay the groundwork for the audience who may have been busy watching Paris is Burning during that time and missed the headlines.
Okay, short selling. It involves borrowing a security, say, from a prime broker, selling it at the current high price, and then intending to buy it back later, or cover the short, at a much lower price. The difference is your profit.
Right.
It signals a strong bearish sentiment, a belief the company is fundamentally failing.
They thought they had the ultimate tuck-making serious money on a company's failure. They were arrogant.
And their key and most feared risk is the short squeeze. This happens when the stock price unexpectedly rises significantly, perhaps due to positive news or, in GME's case, coordinated buying. Short sellers, faced with potentially unlimited losses, rush to cover their positions by buying the stock immediately. This panic buying creates a vicious self-reinforcing cycle.
Driving the price up further.
Exactly. It forces more shorts to cover, and it just spirals.
And what made GME so explosive was the sheer amount of short interest compared to the available float. Help us understand how short interest can actually exceed the total number of shares available to the public. That doesn't make logical sense.
It doesn't make intuitive sense, but it's a consequence of the lending mechanism. So imagine a company has a float of 100 shares. Short seller 1 borrows a share from investor A and sells it to buyer B.
Okay, short interest is 1.
Right. Now, buyer B, who now owns the share, can turn around and lend that same share to short seller 2.
Oh my God.
SS2 sells it to buyer C. The total shares outstanding is still 100, but now the total short interest is 2, or 200% of the original loanable share, if this cycle continues.
Wait. They're lending out the same outfit multiple times on the same night? That is the ultimate financial drag show. It's all smoke and mirrors.
It is, and it means the shorts were monumentally over-leveraged and vulnerable.
Clearly.
The total volume of shares sold short was colossal, and when the internet queens, the retail traders, came for them, coordinating their buying pressure, it was pandemonium. The adjusted close price for GME spiked from below $10 in early January 2021 to over $80 in early February 2021. The trading volume was equally unprecedented, peaking between 700 and 800 million shares in late January.
The consequences were devastating for the institutional girls who got cocky. Tell us the numbers.
Melvin Capital, one of the primary funds, lost 30% of its value in January 2021 alone.
Wow.
Its losses later reached 53% of its investments on just that one position. D1 Capital Partners lost approximately $4 billion during the same period.
Losing 53%. That's not just a bad day, that's a RuPaul, I need my crown back and I need a new career level of failure. The audacity of the shorts was clocked and the public held up the receipt. The audacity. We love to see the little guy win, even if it creates catastrophic losses for the big shorts. Now, let's move into Act 3. Volatility and validation. The cryptocurrency performance. Let's talk about Bitcoin, because if GME was reality TV, Bitcoin is the digital opera, high art, high drama, high price.
Well, Bitcoin remains one of the most volatile and attention-grabbing assets, and we can actually analyze how its performance relates to public interest using data science metrics beyond just simple correlation. Specifically, researchers have looked at the relationship between Bitcoin returns and volatility and the Google Trends cryptocurrency, or GTC, index.
So we are comparing the price action to how many people are frantically Googling, what is Bitcoin? Or did I miss the train?
Exactly. But simple correlation only tells you if two things move together. To understand causation and direction, researchers use a metric called transfer entropy.
Transfer entropy. That sounds like something Professor X uses. Explain it.
It's a concept from information theory. It's essentially a measure of the effective information flow and directionality between two time series. It tells us not just if Bitcoin returns and Google searches are related, but who is leading the dance.
Okay, that is much more useful. So who is leading?
The finding is that there is a reciprocal flow of information, meaning they both influence each other, but it is crucially not symmetric. The key data point is that significantly more information is leaked from Bitcoin return and its volatility to the GTC index than in the other direction.
So the action, the price moving dramatically, either up or down, is what drives search attention, not the other way around.
Precisely. If Bitcoin jumps 20%, people search frantically. If people search frantically, it causes a much smaller, less significant impact on the immediate price.
Got it.
The price movement is the trendsetter. The public interest is the reaction. It's like seeing a celebrity enter the club. The celebrity's appearance is the event, and then everyone rushes to Google, "Who is that?" The action sets the trend, not the chatter.
Bitcoin is leading the narrative, darling. And it's able to do that despite its volatility, because fundamentally, Bitcoin provides a publicly distributed ledger, and when you compare it to like risk-free bonds, it has little, if any, intrinsic value.
Right, based on traditional metrics.
Its value is purely subjective based on collective belief in scarcity, but that belief has driven massive gains.
And because of this disruptive, volatile digital performance, central banks are starting to get nervous about financial stability, which is why they are preparing their own fierce outfit. The central bank digital currency, or CBDC.
CBDC. It's basically the Federal Reserve trying to make their own competing look so the unstable virtual currencies don't steal the spotlight and cause chaos. What are the arguments for the Fed or the ECB to get in this game?
Proponents argue for several significant advantages. First, a CBDC would be more convenient and efficient than handling physical cash.
Okay, sure.
Second, it is fundamentally more secure than commercial bank money, which is subject to credit and settlement risk, because the CBDC would be a direct liability of the central bank, eliminating the risk of bank failure.
So, in theory, it's safer than the money sitting in my local commercial bank because the government is guaranteeing it directly. That sounds like a powerful selling point.
It is. Third, providing a state-backed, stable digital currency aims to reduce the public's use of unstable private virtual currencies or stablecoins, which pose risks to price stability.
Right.
And finally, they argue that increased reliance on central bank money offers macroeconomic advantages, like potentially higher fiscal income for the state and a more robust financial system overall.
It sounds like the central bank is trying to become the only designer in the room, creating a monetary monopoly. But isn't there a critical risk here? If the CBDC is safer than commercial bank money, couldn't people just pull all their cash out of commercial banks and hold it digitally at the Fed? That would fundamentally destabilize the entire commercial lending sector.
That is the most critical risk. That large-scale CBDC adoption could lead to disintermediation, draining commercial banks of deposits, making them overly dependent on central bank credit for lending. Banks need those deposits.
So how do you manage that? How do you keep the central bank money safe and convenient without accidentally burning down the commercial banking house?
One sophisticated solution that's been proposed is introducing a tiered remuneration system for CBDCs.
Tiered remuneration?
Yeah.
That sounds like a fancy pricing system at a VIP lounge.
It is, in effect. It means the central bank introduces a mechanism where small, necessary holdings of CBDCs would receive normal, attractive interest. However, very large holdings, those held by institutions or massive risk-averse investors, would be subject to unattractive remuneration, maybe even a penalty rate.
So they're making big CBDC holdings financially unfashionable. They are telling institutions, yes, this is safe, but we are going to make it too expensive and boring to hoard. Go back and deposit your money in the commercial banks so they can lend it out.
Precisely. It's a delicate balance of providing public security without undermining the necessary function of private commercial banks.
Now let's turn to, Act 3, Scene 3? Risk and reward.
Let's do it.
We have to decide if the financial performance is truly serving a look or if it's just a tragic mess waiting to happen. How do we quantify if the expected return is worth the drama?
We quantify risk using foundational models like the Capital Asset Pricing Model, or CAPM. The core idea of CAPM is that investors should only be rewarded for taking on systematic risk tied to the overall market that can't be diversified away, but not for firm-specific risk, because that can and should be diversified away in a well-constructed portfolio.
In other words, you get paid for being in the risky club, which is the market, but you don't get extra compensation for the drama your specific date, the individual stock, causes. That drama is your fault for not diversifying your dating pool.
That is a perfect way to put it. And the measure of this unavoidable systematic risk is beta. Beta measures the sensitivity of a stock's return to changes in the overall market return. If the market changes by 10%, a stock's return is expected to change by 10% multiplied by its beta. A beta greater than 1 means the stock is more volatile than the market. A beta less than 1 means it's less volatile.
So a beta of 0.83, like Nike stock had during the period studied, means it was a stable, moderately interesting partner safe, reliable, lower volatility than the S&P 500. A beta of 2 is high stakes, high drama, high return potential, but also high risk.
And that's where the personal choice of risk aversion comes into play. We can look at two hypothetical investors, Sam and Rachel.
Sam and Rachel.
Sam is highly risk averse. He will accept additional risk only if there is a substantial increase in expected return. He demands to be significantly compensated for any increase in potential drama.
Sam is demanding. He knows his worth and requires a high premium.
Rachel, on the other hand, is less risk-averse. She'll tolerate added risk for smaller improvements in expected return. She's willing to take a chance on a slightly riskier asset even if the expected payoff isn't dramatically higher.
And the practical consequences.
Because of her higher tolerance, Rachel's optimal portfolio will inevitably be riskier than Sam's. She seeks a position higher up the efficient frontier, but she accepts a higher overall level of volatility.
That is the ultimate personal finance choice. Are you a Sam or Rachel? Are you going to risk a messy night out with a questionable hookup who has a high beta, accepting high risk for the potential thrill of a high return? Or do you prefer the low risk, moderate return of ordering delivery and watching Drag Race? You need to know your tolerance for drama before you step onto the investment runway. We've covered the bad data and the market structure that gives the big queens an advantage. Now let's step into Act 4. Ethical failures, lying, shading, and defaulting. Because the biggest financial disasters are rarely pure market risk. They're usually an ethical failure or a catastrophic lack of controls.
That is the unavoidable truth. Financial catastrophes are often the result of institutional blind spots and a lack of controls, checks, and balances designed to protect the firm from its own unscrupulous employees. And the most direct ethical failing is lying. Lying to colleagues, lying to customers, lying to hide a loss.
Let's talk about the legendary failure, Jerome Kerfield.
Yeah.
This wasn't just a rogue trade. This was a financial performance of epic deception.
Jerome Kerfield was a junior trader at Societe Generale in France, and he single-handedly caused trading losses of $7.2 billion in 2008.
Oh my God.
And just to emphasize the scale, that loss was 1.5 times the bank's market capitalization at the time of discovery.
1.5 times the value of the entire bank. He didn't just break the rules, he bulldozed the whole building and then sold the wreckage. How did a single trader manage a position that large without the bank knowing?
He engaged in monumental systematic deception over several months. He took massive, unauthorized, long and short positions on European stock indexes without taking the corresponding hedges. So he was making gigantic naked bets.
Wow.
As he was losing money, he fabricated evidence. Specifically, he hacked the company's surveillance system and fabricated emails and documents to make it look like his positions were small, monitored, and appropriately managed.
He wasn't just hiding his positions, he was financially gaslighting the entire firm, fabricating surveillance records. That is a level of deception that moves beyond poor risk management and into outright criminal activity.
Exactly. He bypassed the proper risk channels entirely. When he was eventually caught, convicted, and fined the amount he lost, the primary lesson wasn't about derivatives complexity, but about the catastrophic consequences of a complete breakdown of ethical oversight and internal controls.
Kerfield didn't just lie. He committed financial plagiarism by stealing time and effort from his colleagues and cheating the system. That is a level of deception that deserves a final, non-negotiable sachet away from the industry.
And this type of ethical failure isn't confined to trading desks. It can be baked into the very structure of financial products, particularly mortgages. This takes us to a critical analytical framework, viewing home equity through the lens of options, or derivatives.
Okay, so options are derivatives that grant the holder the right, but not the obligation, to trade an asset at a fixed price in the future. So how does my house relate to a call option, which gives me the right to buy?
When a homeowner takes out a mortgage, they're essentially long a call option on the house's value, with the mortgage debt being the strike price. They have the right to claim the profit if the house price rises above the mortgage debt. Conversely, the lender is short a put option on the house's value, also struck at the mortgage level.
So the lender wants that put option to expire worthless. They want the house price to stay above the debt level.
Absolutely. If the house price exceeds the mortgage, the homeowner keeps paying, the lender is paid in full, and the options are out of the money for both parties. But here's the danger, especially during the 2008 crisis. If the house price falls significantly below the outstanding mortgage debt, the call option is worthless for the homeowner. but the put option becomes in the money for them.
And what does that option grant the homeowner?
It grants them the right to default. They can walk away from the loan, hand the keys back, and the lender loses part of their repayment because the collateral house is worth less than the loan amount.
A free option sounds amazing, like getting a free drink ticket or a free pass to skip the line. But in finance, it means trouble because it encourages recklessness.
And that is exactly what happened when lenders started giving mortgages with no money down. This is essentially giving a free option to the homeowner, which is financially dangerous because it invites speculators and creates asset bubbles.
Right.
I mean, think about the leverage involved. The SEC limits stock buyers to 50% financing, but during the bubble, mortgage leverage could be 80%, 90%, or even 100%.
That is astronomical leverage.
If a house increases 10% in price, you profit 50% on your initial 20% down payment. It's a high reward.
Yeah.
But if the house value drops 10% and you have zero equity, you can just walk away, leaving the lender holding the bag.
They get all the upside. But if the market fails, they have no personal skin in the game, so they can just walk away. It creates reckless behavior, it incentivizes short-term speculation, and it fundamentally contributes to systemic risk.
And that leads directly into our final point on risk management, concentration risk. Systemic failure often occurs when firms fail to diversify their risk portfolios properly.
Diversification, honey, is the key to life, relationships, and portfolios.
Yeah.
You cannot rely on one source for everything.
Indeed. We can identify two major risks that contribute to systemic failure. First, credit spread risk. If the yield spread between high-quality commercial bonds and risk-free government bonds increases, it signals higher credit risk for the borrower.
Okay.
When this happens across the market value of all outstanding loans and bonds held by lenders drops, causing substantial market value losses.
That's the entire market recognizing the drama is escalating because risk has gone up globally.
Second, and maybe more intuitive, is concentration risk. This is when a bank's portfolio is heavily concentrated in a single sector, asset class, or geographic region. Think of Countrywide Financial,
Right.
whose entire balance sheet was overwhelmingly tied to the U.S. real estate industry. When adverse events in that single sector occur, the lack of diversification means catastrophic. Substantial losses are inevitable.
Concentration risk is when you try to date only one type of person.
Yeah.
And they all end up being the exact same brand of trauma. When that specific type of person fails, your whole dating portfolio collapses. You need balance.
And this concentration risk causes a domino effect of failure across the entire system. This is why diversification is so important, using securities that have less than perfect correlation to lower the overall portfolio volatility. You need stability through varied investments that don't all move in lockstep.
We have journeyed from synthetic data wigs to institutional short squeeze breakdowns, from mysterious options theory to the failures of unethical rogue traders like Jerome Kerfield. We've exposed the fact that the underlying data is flawed and the market structure is strategically fragmented to favor those with the most capital.
If we connect this to the bigger picture, trust in modern finance isn't about blind faith. It's about acknowledging the inevitable biases in the data like survivorship bias and look-ahead bias,
Right.
and the structural incentives for non-transparency, whether from data vendors or market venues like dark pools. The core ethical decision facing modern finance is whether we prioritize maximum velocity and institutional advantage or transparency and stability.
The ethical failures, from Kerfield's deception to the structural recklessness of giving out free mortgage options, demonstrate that even with perfect data, integrity is the ultimate vulnerability.
Totally.
The system is complex, the technology is moving faster than ever, but the ethical rules are simple. Don't lie, don't shade, and don't take on risks you can't personally afford to pay for.
And we've armed you with the detailed information needed to spot these flaws and ask the critical questions of the financial information you consume.
Absolutely. You've been read, educated, and entertained. Go forth and check the receipts on every single data point you encounter.
But before we make our final celebratory sachet away, here is one final provocative thought for you to mull over. Our sources noted that the U.S. Federal Reserve operates with a foundational dual mandate, achieving maximum employment and maintaining stable prices.
The two pillars of monetary policy.
Right. But given how deeply we've demonstrated that data quality problems, including bias, lack of stability, and lack of transparency impact financial stability, policy modeling, and ultimately policy decisions, should we now demand a triple mandate for central banks? Should that mandate explicitly include the imperative of ensuring data integrity across the entire financial system?
A mandated commitment to data fidelity and transparency. If the basis of all our economic understanding is flawed, perhaps the Fed's job should extend to fixing the foundation before they build the roof.
Something to think about.
Think about that next time you see a headline about financial regulation. Until next time, keep diving deep and stay fabulous.